I look at the property market for a little bit as well. I also look at some of the cash markets occasionally, but not too much. I don't try to. What I'm looking for is where the money's moving. Is probably really what it's about. And we're talking about the economic clock to somebody recently, and it's sort of the same thing. There's like an investing clock. You know, it moves from bonds to property to shares to bonds to property shares or cash, and so we're now starting to move back into shares, and I think property and shares are going to start to move a bit together, which they've been more in the last 20, sort of 30 years have started to move a bit more together rather than being one, then get out of that and get into the other one. They're both moving together. I think the property market's going to slowly move a little bit, especially in the low interest rate environment, especially if the interest rates keep going down. And I think the share market will do okay over the next few years, as I said, but we still need to come down into a 4-year low in the next 12 months, and that'll probably be maybe a 15% fallback-ish. But long term, I like the share market right now. The whole idea of FoFA and conflicted remuneration is really about opening up the marketplace, but I think it's actually going to do the opposite. It's actually constricting it, and we're seeing the BTs out there buying up dealer groups, and I'm going to see you'll be seeing a lot of those. BT will be buying up more dealer groups, and it's actually going to be less advisors out there, and it's going to be not necessarily as good for the mum and dad on the street. I mean, at the moment we're still only seeing 20% of people getting a financial plan or using them, and to me what's going on with FoFA is not really going to help mum and dad going to see a financial advisor, because you've got lots of advisors have lots of C and D clients, really. They've got A and B clients, they'll keep those. With opt-in or opt-out, whichever way you want to talk about it, you'll see a lot of them not wanting their C and D clients to focus on their high net worth type of clients. And so I think from a point of view of the retail investor, I don't think they're going to get as much choice anymore, and I think it's going to pull the industry together into more of a silo rather than a broader brush approach, which should be happening in this industry, but it's not. That's one way of doing it, absolutely. It's just about reducing cost base. That's all it is. And the cost of providing advice has been traditionally high because most of the industry has been run by large dealer groups. And you know, they really do, I suppose, for want of a better way of saying it, rape and pillage, so to speak, with their products, with high fees on their products, high commissions they're paying, all that sort of stuff. So the advisor's generally paying for that. But if you make it cheap for the advisor to run their business, then their fees are going to come down as well, and mum and dad will be able to afford it. And that's what needs to be out there in the industry is to turn the tables upside down and have the financial planner in control of their own business, more so than a big dealer group type of situation. And we're in a technology age. Technology makes things cheap. If they've got the right technology at their fingertips and it can reduce their cost dramatically, then the advisor will be able to reduce their fees. And that's what needs to happen. Absolutely. I said your big players just can't move. They've bought legacy systems, you know, and that really is, and they're very old technology. Banks have very old technology, but it's too expensive for them to change. And there's also a lot of capital gains tax issues of moving people around, also between products and off platforms, which is another huge issue. So over the next sort of 5 to 10 years, as FoFA changes take hold and the conflicted remuneration comes into place and everything else, and people slowly move off these platforms, then we're going to start seeing a lot more bigger changes in the industry. But the industry in 5 to 10 years time won't be like it is today, and it needs to be that way. What's going to happen is the change is not going to be driven by your BTs, it's not going to be driven by your AXAs and those big players. It's going to be driven by more independents or smaller companies that are able to move and deliver the technology that people actually want, the advisors want and the clients want, because they do deserve it. And really the retail client does deserve a better system, and they haven't been getting it for many, many years.